We are about to hit a recession. At least that's what Wall Street Silver says and what the media wants you to continue to stress about. But I'm going to tell you something right now. The economy and the stock market are two completely different things. And I'm going to go ahead and utilize this article that's been going around on Twitter right now. It's been viewed 5.2 million times to show you exactly why the stock market and the economy are two completely different things most of the time, and why following and trading off of this type of news, this type of headline, is potentially going to lead you into blowing an account. All right, we're going to start off with something called Dow theory. Why? Well, simply because we're talking about a logistics, a trucking company, right? And this matters in this context. Let me take you back about 120 years. Charles Dow. You know the Dow Jones Industrial Average. You know the Dow Jones Transportation Average. This guy was smart enough to index 30 of the most important industrial-related stocks 120 years ago and throw them into an index. That's where we got the Dow Jones Industrial. Then he went ahead and put the 20 most important transportation stocks. Actually, it was 9 back then, I believe, and they were all railroad at the time. The 9 most important railroad stocks, averaged them out. And what he said was essentially, this is the transportation average as of today, that if the transportation average and the industrial average are both moving in the same direction, the economy is efficient. It doesn't have to be up or down, but you know that the primary trend is established. So in this context, if the transportation average is moving up, that generally means the economy, at the very minimum, the demand side of the equation here, supply and demand on the economy, demand being the consumer buying more products, they need to ship them. That's the demand. If the transportation average is going up, that's not a bad thing. And if we look at the Dow Jones Industrial Average and we go, well, which way is this going? Is it up, down, or sideways? Well, right now, at least going back to October, it's up, right? So we have some confluence here between the industrial average and the transportation average, both pressing up over the last almost year, and into all-time highs, by the way. The industrial average, according to Dow, was the supply side, right? The companies that are actually making the products. So when you have the supply side of the economy, as shown here by the industrial average 120 years ago, hitting new highs, pressing up into higher uptrends, you have the transportation average, which is the demand side, pressing up into new highs. It's showing that supply and demand are both in bull markets and that we should be buying stocks, right? This is like one of the very basic Dow tenets. There's many of them, but this one really stuck out with me because it's a very simple way to figure out whether or not a part of the market is starting to lie. And what Dow said was essentially, if in his day, these were the only two big ETFs, if you will, indexes, I should say, not ETFs, but indexes that existed. He was the first one that came up with this concept. He said if one of them started to diverge from the other, like for example, let's say right here, the industrial average starting to slow down, still hitting higher highs, but definitely starting to see some potential breaks and lower lows. And then we finally got it back in January of 2022. If that did not match the same sort of vigor as the transportation average, then there was a problem. But if you noticed, transportation average actually broke before the industrial average. So what would Dow say? This is caution. Not necessarily time to sell off all your stocks 120 years ago, but if the transportation average gets disaligned from the industrial average, it's time to slow the hell down, at least in terms of buying stocks, right? So now we're in this unique situation where the Dow Jones Transportation Average, which is realistically the crux of what we're talking about today. So I'm going to keep this chart on the screen for you for a second because it's important. We are damn near at an all-time high. We are up right now from June lows over 20%. And from when the market bottomed at the beginning of middle of September, rather, we're up almost 40%. Guys, the Dow Jones Transportation Average right now, as it sits, is less than 3% away from all-time highs. I cannot stress this enough. The transportation sector is screaming at us that regardless of what the headlines are saying, you should be looking to own the stocks inside of this index because they are killing it. And I can prove it to you. So let's go back to the tweet here. Recession. What recession, right? Obviously, tongue-in-cheek. Everyone, there's no recession. Of course, everybody expects a recession. That's probably why it's not going to be as bad as everybody expects. As a matter of fact, if you've been paying attention for the last 12 to 14 months, all of the major manufacturing indexes coming out of Philly and Dallas and these huge industrial hubs have been down for quarters over quarters, showing us that the manufacturing areas of the United States are already in a recession. Just because it's not glaringly staring at us in the face through GDP does not mean that there is not some internal recession going on. It's been going on. So this tongue-in-cheek comment here, recession, what recession? Everyone's so happy. No. But he backs it up by saying the third largest trucking company just ceased operations. If you know anything about Yellow, you ever worked blue collar, you know anything about logistics, this was a pretty big company for a long time, actually. Cash-strapped U.S. trucking company Yellow has ceased operations and is filing for bankruptcy after failing to reorganize, blah, blah, blah. And oh my God, all of the comments here. Recession is coming. Bulls are stupid. We're all going to lose our ass. Everyone's going to lose their job. Guys, this is such bullshit. Straight up. This is so stupid. Taking this type of headline, I want you to look at something. I'll show you this in a sec. I typed out a response tweet. I need you guys to see it because that's going to be realistically what this entire video is about disaligning the economy from the stock market. Let's go ahead and look at Yale, right? Let's go ahead and look at Yale for the last, 10 friggin' years. Let's go back to 2013, 10 years ago, prior to the little pop we just had. This thing was down 97, 98%. I don't know how I have to prove it to you that COVID and the recession impending because of it is not the reason why Yellow is going bankrupt. Yellow lost 98% of its market cap over 10 years because it was a bad company. You don't lose money, this much money, for this long and not go bankrupt. Of course, there's going to be a catalyst that eventually shoves you over the edge, right? Yes, we are supposedly slowing up on a recession, but even prior to COVID and the recession coming, this company already sucked. This company sucked. So to sit here and pick this particular company out, Wall Street Silver did, right? Third largest trucking company really evokes that emotion in you. Oh my God, the third largest. And then you go and you just pull up a goddamn price chart and you go, this stock has sucked for 10 years. Why is anybody out of their minds worried about this? This is the type of company that should go under. This was poorly managed. You can name a million different reasons. I can see it in the price chart. Nobody has wanted to own this consistently for a decade. That generally means bad news for the underlying stock. So let's actually look at my response really quick. Great example of economy is not the stock market, right? The Dow Jones tracks transportation industry within the USA 20 market weighted, which is important. This is market weighted, all right? Transportation stocks spread across multiple industries. You have airlines, Alaska. You have American, right? You have CSX, which are railroads. You have logistics companies, FDX, right? FedEx. You have UPS. You also have trucking companies. So there's lots of different exposure within this Dow Jones Transportation Average. And once again, I don't have to prove it to you. I just did. We're pressing up into all-time highs, guys. All-time highs. Yellow is not incorporated in this index for a reason because the stock fucking sucks. That's why. So to sit here and cherry pick this and say the third largest trucking company is going out because there's a recession coming, excuse me, bozo, but the rest of the market doesn't agree with you. You can cherry pick Yellow all you want. That's fine. So I went on to say, instead of focusing on healthy consolidation and uptrends of transportation companies that are killing it, which we can prove because an index is just a summation of all of the stocks inside of it. And if it's going up, that means a majority of these are going up. It's math. It's not emotional response. It's not my opinion. It's fucking math. So when this is going up, a majority of the underlying assets inside of the index are going up. Instead of focusing on those, writing out these news reports that show you UPS is about to kill it, we're hitting new highs in railroads, we're doing all of this stuff, that doesn't fulfill that doom porn type of stuff that people love to consume. They love to feel like the world's about to end. They need to know this right now, otherwise their life is over. That's why they cherry pick this type of bullshit and feed it down to you to get clicks because they get paid for it. But you do not. You take trades on shitty stocks like this with biases wrapped in complete garbage and lose money. You're essentially handing your hard-earned cash and your attention to content creators. That's where I come in. I create content and I hate it. I prefer to trade. I prefer price. I prefer data. I prefer no bullshit, right? So instead of focusing on the healthy consolidation and uptrends of transportation stocks that are killing it, they're going to use a company, a legacy company no less, it's old as shit, that has been in decline for over 10 years as a bastion of an impending recession. Please, once again, tell me why Yell is of big importance when it's lost 97% of its market value over the last 10 years. Tell me why. As I said earlier, most stocks that go down that much for that long go bankrupt already. There's generally going to be a catalyst that really kicks them out. You think of, man, what are some, Macy's almost went under. That fucking company sucks. Who the hell shops at Macy's for the last 10, 20 years? You know, if I would have, you ask our parents, Macy's was one of the greatest. Sears, one of the greatest. But shop consumer trends have changed. You see that in reflection in the price. We see some of the car rental companies that were about to go under during COVID. Those were poorly managed prior to COVID. COVID was the reason that pushed them over the edge. Now, obviously, not all of them went under. They got bailed out, etc. Yellow is no different. This is no different. It's a shitty company. It's been bad for a decade, and now it's starting to feel the crux of what happens in an economic slowdown, supposedly, and you're a shitty company. You get outcompeted by other companies. Yellow is being actively outcompeted by all of these. So guess what? Fuck you, Yellow. Maybe people are going to be shipping with Expeditors International. Maybe they're going to be shipping with FedEx. Maybe they're going to be shipping with United Parcel Services instead of Yellow. So to sit here and say, man, the world is ending, recession is coming, everybody sell all of your stuff is bullshit. A slowing economy and potential recession, right, which I don't necessarily disagree with. There's probably going to be a recession, but I am rooted in logic and price, not in emotion, except when I'm making this content, because this is a fucking stupid tweet, and hopefully I'm giving you guys an opportunity to think about something a little differently. Slowing economy and a potential recession might have put a nail through the heart of Yellow, but it sure wasn't the reason it started. A decade ago, it started. Actually, it was way longer than a decade ago. I didn't go back far enough, but I think if we go to Yelp, something happened here a long time ago that looks like it's lost a majority of its value over a long period of time. Looks like there was a split, so obviously there was a problem, right? There's been a problem with the stock for an extended period of time, and they're trying to fucking save it. It didn't work. So I'm going to leave you with this. As a technical trader, your job is to trade price, not narrative. Headlines like this cause clicks, and clicks pay content creators. That's why I create these videos. Eventually, I would like to get this channel monetized. I get about 50 to 100 views because I'm not superly out there. I don't throw my personality out there. I really want you to focus on the material and what I'm trying to teach and not me. But this type of shit really pisses me off. Nothing wrong with making content that gets clicks. They have careers around this, but it's not a reason to build a bias around a trade. I'm telling you right now, stick to the only thing that matters, which is price. And if there's one thing you can take away from this goddamn video, it's that fuck Yellow, the supposed third largest trucking company in the United States, going under because the Dow Jones Transportation Average is less than 3% away from an all-time high. And we can look at the Dow Jones, Dow Jones Industrial Average, which is, once again, I've made a couple videos on this in the Market in Focus. We're less than 4% away from all-time high. If you think that this is going to crash to new lows within the next month or two, you're going to get destroyed. You've probably been destroyed all year. Don't follow this type of shit. Keep your head on a swivel, follow price, and you'll do well. There's no sales pitch. Follow me on Twitter, How to Swing Trade. See ya.